Well, insurers and reinsurers struggle with that question too. Then briefly on the terminology I'll use. For the sake of simplicity, I'll use the word policyholder rather than prospective policyholder or applicant, even when the insurance isn't effective yet. And similarly, policyholder knows better is shorthand for there is adverse selection, and the insurer knows better, shorthand for there's no adverse selection. So far I've discussed theory or assumptions and not evidence. There's a lot of evidence. The theory of asymmetric information has attracted much attention. Economists tried to prove that it was correct, that the predicted results could be observed in the real world. Information asymmetry plays a role in many markets. However, finding the data to prove its existence is not easy. Insurance markets were found to be the exception. As the economists say, insurance offers structured data. And they mean by that, we've got all those data on the characteristics of the policyholders, of the risks, and of the claims. So many empirical studies are based on the data from insurance companies. As we know, the insurance variety of information asymmetry is adverse selection. The empirical studies are trying to find out whether it exists. So let's see what's exactly being measured in these studies. The assumption was that the bad risks are more inclined to insure. That results in two research questions. The first is, does the policyholder know better? And the second, does he or she buy more or less insurance as a result? And I will focus on the first question. So from the researcher's point of view, can I think of something, a trait of the risk, that the insurer didn't use for rating purposes? And can I prove that policyholders who have that particular trait purchase more or less insurance? And so the researchers tried to see whether they could predict losses more accurately if they put in, for example, socioeconomic status, a more refined claims history, and so on. Dozens of those empirical studies have been published. A paper by well-known Peter Siegelman and Alma Cohen, published some 10 years ago, provides a good overview. A number of others have been published since. Some didn't contain sufficient data for my purpose, and all in all, I was left with 30 empirical studies that I could use. That's not enough to call it a representative sample of world insurance markets. However, the studies cover several countries and several classes of insurance business. Together, they should give a fairly broad picture of what's happening in the world of adverse selection. So what's the verdict? The results are mixed. 16 of the studies found evidence of adverse selection and 14 didn't. That's about 50-50, and it's far from convincing evidence that adverse selection is a widespread phenomenon. It's time for a brief intermezzo here. We're faced with a challenge. On the one hand, there's an elegant theory, and on the other, there are many empirical studies, but nearly half of those contradict the theory. So how do we go about it? Well, this is my approach. First, the theory dates from 1970 and most studies from 20 to 50 years later. But the question is, has insurance practice changed in those years? Thereafter, we'll dig deeper into the studies and see if an explanation can be found for the positive and the negative outcomes. So the first question is whether insurance practice changed since 1970. And the answer shouldn't surprise. I can testify that it changed quite dramatically. I happen to be right in the middle of it. Not as a key player in the changes, far from it, but certainly as an observer from within. The last 50 years were the age in which large-scale data processing has been introduced. First, there was the arrival of the mainframe computers, then of that of the PCs, and subsequently we got all those sophisticated statistical tools. Computers took away several tedious administrative jobs, but for the purpose of this talk, something else is far more important. IT had provided an insurance company with the tools to refine their premium rates. That brings us to the question, how insurers set their rates. Well, that's a complicated process. To the outsider, most of the time it's a black box, and indeed, for competitive reasons, it's likely to remain that way. That being said, the principles are quite simple. I will only briefly touch upon those. The key words are risk factors and risk classes. Insurers have always used a number of risk factors to classify the risk. In life insurance, age is the prime example. Life expectancy decreases with age, so the premium rates have to go up, in term assurance that is. Likewise, gender has always been used as a risk factor because life expectancy of females is higher than that of males. Risk factors define risk classes. Take again age as an example. Say an insurer uses intervals of 1 year to define age and accepts people from birth until the age of 70, then you have 70 risk classes. If you add gender as a risk factor, you have 140 and so on. Or to mention another example, when I started in insurance, rates in auto insurance were based on a very limited number of risk factors. Examples are the price of the car, the age of the driver, mileage and claims history. Age was expressed in just two categories, under 23 and over. And there were similar crude approaches to the price of the car and claims history. All in all, we probably distinguished a few dozen risk classes in auto insurance. That changed considerably over the last decades. Actuaries and statisticians did what the economists had been doing in the empirical studies that I mentioned earlier. You remember that they tried to identify traits of the risk that had not been used before by the insurer. If that particular trait made the estimate of the risk more accurate, it would be included in the calculation of the premium. In insurance terminology, that trait turned out to be a risk factor. An example of the risk factor that's being used in car insurance today, but wasn't 50 years ago, is the thing I mentioned earlier, the address of the policyholder. It's an indication of the socio-economic status, and that in turn is an important risk factor. Something similar happened to existing risk factors. If analysis showed that refinement would increase accuracy, it was introduced. And so, in disability insurance, age was no longer expressed in years, but in months. Claims experience in car insurance no longer in 4, but in 12 grades, and so on. I told you earlier that 50 years ago, an insurer would typically have a few dozen risk classes in auto insurance. 30 years later, the English insurer I worked for had 20 million risk classes, or rating cells as they called it. That was some time ago, and no doubt the number will be much higher now. I will return to the importance of risk classification later, but first we should have a look at the dynamics of the process. I would like to show you a graph, and don't worry, it's a simple one, and it's the only one in this presentation. So what does it mean? In a certain line of business, say again auto insurance, there are two competitors. We call them the traditional insurance company and the new rate insurance company. I hope there are no companies of that name, and if so, my apologies. Traditional is represented by the blue line and new rates by the red. In its rating, traditional uses 10-year age bands. It means, all other things being equal, same car, same mileage, and so on, that someone aged 29 pays exactly the same premium as someone aged 21. You see that in the blue line here. New rates had always followed that practice, but recently hired a statistician to further analyze its claims data. This person found that it would be more accurate to charge the low ages more and the high ages less here. It's indicated by the red line. New rates refines its risk classification and sets its rates accordingly. Look what happens now. Traditional, the blue line, will lose on both ends. On the right-hand side, here, it's not competitive and it will lose good risks. On the left-hand side, it's underpriced and consequently it will attract bad risks. Traditional has no choice but to follow new rates in its pricing policy. This type of dynamics presents itself in all shapes and forms. A well-known example in the history is the introduction of the non-smoking rates in life insurance. Once one company had made a distinction, the others had to follow. That's why one can say that the process of refining risk classification is a one-way street. So what for the dynamics of the process? Let's have a look at the consequences in a bit more detail. What, for instance, does it mean to have some 20 million risk classes? In particular, what's the impact on the concept of good or bad risks? The concept dates from the time when risk classes were large. If all people of the same age are one risk class, you're part of a group that consists of millions of people. Under those circumstances, one can imagine that you could label yourself as a good risk. Say you're in excellent health and you never see a doctor. All your grandparents are in their 90s and still in good health, so you have every reason to believe that you're better than average. Now, that may have been the case 50 years ago, but now turn to the situation that you're part of a risk class that consists of just 20 people. It's become nearly impossible to say that you're above or below average. How on earth would you even know what average is? So let's forget about good and bad risk as compared to an average on which the premium is based. Obviously, there are still heavy risks, the ones for which insurers charge a high premium. The rate for a wooden house will be higher than that for a house built in brick. They are not necessarily bad risks as long as the premium is adequate, and vice versa, the same applies to light risks. I would like to add a note here that refining risk classification has to be seen as a trend. I highlighted the dynamics of the process, and that's an important qualification. It's not a fact. You don't see the same level of risk classification everywhere. For instance, in a former communist country, you wouldn't expect refined risk classification 1 year after liberalization. It takes time. And then statistical analysis is time consuming. Insurers, you would expect, will allocate their resources in a rational way. They will start with the most important class of business, and usually that's auto insurance. And finally, sometimes insurers know that their rates can be refined, but they prefer not to rock the boat. In those cases, it might take a new entrant to trigger the change. It's time for another brief intermezzo. Where do we stand now? First, we've got a theory dating from 1970 based on the assumption that the policyholder knows better than the insurer. Second, we've got a number of empirical studies testing that theory, and about half of those studies confirm the assumption and the other half doesn't. Third, we looked at the way in which insurers set their rates and concluded that the process has changed dramatically in the course of 50 years. It has become much more refined. Bearing that in mind, I'll explore with you a different approach to the theory. I hope that it will give you a clear picture of when and where adverse selection can be expected. It's not just a theory. The examples I will give to you have been taken from the empirical studies which I mentioned earlier. Well, I'll do that using a number of scenarios. The first one is called No Impediments, and it's a bit of a fairy tale world. Subsequently, we move in a number of steps to the real world. Now, what do I mean by no impediments? It's a situation in which insurers face no impediments whatsoever in gathering and using information. That is all the information they need to estimate the risk properly. So there are no regulatory restrictions, at least not in rating or risk classification. And all the policy holders only tell the truth and nothing but the truth. And the policyholders do not change their behavior because they're insured. They're just as careful as if they weren't. There's no social insurance either. At least there's nothing that's comparable to, and so to say, competes with private insurance. And finally, all private insurers happily share their claim statistics, and they're all equally competent in interpreting those data. In short, it's a scenario in which I've taken out everything that makes working in insurance interesting. There are no regulators, no cheating clients, and there's no real competition. It's a very boring situation indeed, but bear with me for a few moments. We'll return to the real world soon. So, in this no impediment scenario, who has the better knowledge of the risk? The insurer or the policyholder? There can be little doubt that it is the insurer, certainly after all the developments we discussed earlier. The insurers have the data and they have the tools and the skills to analyze these data. Please note that this is an assumption too. The scenario differs too much from the real world that it cannot be verified. However, it's not completely speculative either. There's no sign of adverse selection in markets that come close to my no impediment scenario. Car insurance in Europe is a good example. Hardly any adverse selection has been demonstrated there. In one of the studies, a French insurance executive is being quoted. He believes that even if there's any asymmetry of information, it's the insurer who's better informed. I leave our no impediment scenario and move one step closer to the real world. I'll do that by reintroducing restrictive regulation. By that I mean any rule that either prescribes insurers companies to use a certain premium rate or tells them not to use a certain risk factor. In both cases, the insurer is forced to apply a rate that differs from the actuarially fair rate. And it's easy to see that now the policyholder may know better. And indeed, that's what the studies find. When there's evidence of adverse selection, there's often restrictive regulation. It was, for example, found in crop insurance, where the rates are effectively set by the government, and in health insurance, where certain medical conditions may not be used for rate setting. However, not all such regulation tips the balance of information in favor of the policyholder. I will give you two examples. First, genetic information. You may have heard Anja Prince's presentation last year. She discussed bans on the use of genetic information. One of the examples she mentioned was the Florida state law. Insurers were worried about the effects and they actively lobbied against it. They didn't have success, and the remarkable thing is that so far, at least that's what she told us, there's no signs of serious adverse selection. A second example, the ban on gender-based pricing operating in the European Union. Differences between the genders had always been common practice. As we all know, females live longer, and inter alia that meant that they paid more than males for the same pension. That was seen as unfair discrimination, and the case was brought before the Court of Justice of the European Union. The court ruled that gender-based rating would not be allowed anymore, and that was 10 years ago. All the ingredients for adverse selection were there. One would have thought that we would have seen the first empirical studies by now, but nothing. And I've spoken to a number of insurance executives on the subject, and it's certainly not been their main worry. So what's the explanation? As far as I know, there is no widely accepted answer. However, I offer you two alternative possibilities. First, it's possible that demand doesn't quite react the way that's expected. Theory predicts that as a policyholder, I would buy more if it's cheap because I'm a bad risk. Well, that might be rational behavior, but other considerations might be more important, such as do I need it or can I afford it? There's another possibility. Under normal circumstances, insurers have lots of information at their disposal. So much so that taking away some of that information doesn't matter too much. In other words, denying insurers access to one risk factor might not immediately tip the balance of information in favor of the policyholder. Whether it's the first alternative, the second, or a combination of both, well, that's an object for further study. Despite all this, restrictive regulation remains an important source of adverse selection, but less so than what one would expect at first sight. We'll move again one step closer to the real world. In the no impediment scenario, it was assumed that policyholders are honest and that their behavior doesn't change because they're insured. In the real world, obviously, that's not the case. We may not like it, but it's a fact of life, all with a slight variation to former President Truman saying, if you can't stand the cheat, get out of insurance. Okay, that being the case, what's the effect on adverse selection or on information asymmetry in general? Well, I'll skip two cases. First, the real serious and discovered cases, people putting fire to the house, etc. They cause considerable claims handling cost, but they will not receive any policy benefits. Second, the well-known ex ante moral hazard. People who are insured will not be as careful as those who aren't. There's undoubtedly some of that, but it's difficult to define and even more difficult to measure. So that takes us to the undiscovered cases. They are a different story. It's about the people who bend the truth a little, the person who conveniently forgets in the application form that he'd undergone some medical treatment. Or it's about a person who has a real claim but exaggerates its size a bit, and so on and so forth. As an insurer told me, it's all across the social spectrum, as much among the well-earning lawyers as among the working class families. These things are, of course, difficult to quantify because they haven't been discovered, so we have to rely on estimates. And they're in the range of a few percent of premium. That's unpleasant and is always too much, but it's not a cause of market failure. Expense ratios in personal lines range from 20 to 40%, say. Ending 4 or 5% for undiscovered fraud doesn't change the picture completely. It's like the effect of shoplifting on supermarket prices. It causes inefficiency, but it doesn't result in market failure. One study has been published that illustrates an exceptional case. It's a bit about the Israeli car insurance market in the late 1990s. In those days, there was no exchange of information between companies on claims history of a certain client. Take the following example. Policyholder X had caused 4 collisions in 2 years. Because of that, the insurer raised his or her premium. Policyholder X doesn't like the increase and applies for insurance with another company. The applicant, same Mr. X, declares that he or she has not been involved in any accidents over the last 5 years. Because there's no exchange of information between insurers, there's no way that the new insurer can check that statement. People learned quickly, and the result was that answers on the application form were, as one insurer put it, substantially inaccurate or incomplete. The study found evidence of serious adverse selection in the Israeli car insurance market. As a follow-up on this one, legislation was changed later. Now insurers are obliged to share information on claims history, and the adverse selection problem has disappeared. And this concludes the second step towards the real world, the introduction of misrepresentation and moral hazard. Taken together, they certainly cause inefficiency, but serious information asymmetry is rare. Again, we move one step closer to the real world. There's not just regulation and fraud, but there's also the effect of social insurance. I can't possibly discuss effects of all social programs, so I'll give just one example, one that I think is pretty typical. Say there's a social insurance program that provides adequate cover for lower income groups. Also assume it provides no cover for everyone earning more. It could be a program for health insurance, but also for old age pensions. I could add more features, but for my example, this is sufficient. What happens to private insurance in these cases? Well, private insurers will focus on the higher income groups and hardly sell anything to the lower income groups. They will set their rates, as they always do, based on the analysis of their claims data. However, that claims experience is limited to the higher income group. So what if income is a risk factor? There's at least one example of that. In very general terms, low income groups have a life expectancy that's lower too. This means that in pensions, they are the good risks. So let's explore that a bit further. There's a social program for old age pensions. It provides cover that is adequate for most members of the low income group. Private insurers focus on the higher income group. They are the heavy risks in this example. They live longer, and the rates the insurers charge are based on that experience. For the low income group, these rates are not attractive, they are the good risks. It's not exactly an example in which the good risks have been driven out by the bad, but the effect is pretty much the same. There's one study that discussed such a case. It was about the old age pensions in the UK. The study concluded that there was adverse selection. After its publication, at least one British insurer introduced a special rate for lower income groups. They did that on the basis of the zip code. So the study not only concluded that there was adverse selection, it also provided a trigger to solve the problem. Now the opposite. The low income group is not the good but the bad risk. Then there's less of a problem. I assumed that a competing social program provided adequate cover for low income group. So occasionally there might be a low income applicant for the private insurance, but there will not be many. They might get in cheaply, but not in sufficient numbers to greatly influence the rates and drive out a good risk. That was the third step towards the real world, the introduction of competing social programs. In general terms, the consequence is that private insurers have claims data that do not cover the whole population. Consequently, that applies to the premium rates as well. In rare circumstances, that may cause anomalies, but again, the conclusion is the same. It's not likely that adverse selection becomes a problem under those circumstances. And now a final step away from the no impediment scenario to the real world. We have reintroduced regulation fraud and competing social programs, we still assumed that all insurers share data and that they are equally competent in interpreting those data. That, of course, is not realistic either. Claims data are most of the time a carefully guarded trade secret. And as regards the competence, of course, there are differences. Not all companies are equally well managed, and if nothing else, there has to be a difference between insurers that hire graduates from Connecticut Law School and those that don't. And if that hasn't been confirmed by a study yet, it's perhaps a suggestion for the future. Let's again take a simple example. In a certain country or state, there are two insurers. One specialized in risk in the urban areas, and we'll call it the Urban Incorporated. The other one focused on the rural areas. It's called Rural Mutual. They're both equally well managed. They have carefully analyzed their claims data and created risk classes on that basis. Both have profit margins that are reasonable but not excessive. Each company would like to expand and do so by entering the area of the other. Let's assume that they have to compete on price. Just undercutting the other by, say, 10% is not an option. The profit margin doesn't allow for that. So ideally, each insurer should mirror the rating structure of the other, but it lacks the data. And consequently, their rates will be less accurate. In certain areas, they might find themselves in the situation of the company that has the least refined risk classification. You will remember the graph that I showed you earlier. I promise you only one graph that's actually the same as the previous. I just added a few different words. The company that intrudes into the other area, that's urban in this graph, will have the less refined rates. You've seen this in the graph before, and the conclusion should be familiar. The consequences for the intruding company, that's the blue one, are similar, twofold. For some risks, it will be too expensive here, on the right-hand side. That's not our biggest worry, though. They just don't get the business. Much more dangerous is the left-hand side. It's the area in which they are underpriced, and if urban is not careful, it will get a lot of those loss-making risks. And this can happen in all shapes or forms. It could be a result of focus on different geographical areas, on different professions, or it could be the consequence of difference in management competence, which I mentioned earlier. The mechanism will be clear. The company that competes on the basis of incorrect rates will lose out. If it doesn't correct the situation, it might even jeopardize the future of the company. That in itself is nothing new. Being underpriced has always been one of the most frequent reasons for bankruptcy of insurance companies. It's just that things happen faster with internet-based underwriting. Again, look at the example of the non-smoking rates in life insurance. You might ask, all very well, but what does it have to do with adverse selection? And strictly speaking, the answer is nothing. The key element of adverse selection is that the policyholder knows better than the insurer, and in my example, the policyholder doesn't know better. He or she just opts for the cheapest rates. So the next question is, if it isn't adverse selection, why is it important within the context of this talk? Well, it could be the outcome of empirical studies that test for adverse selection. Imagine that someone would have studied the expansion of the urban insurer into the rural areas, the example which I gave you. That study would have found evidence of adverse selection. It would have found that the bad risk purchase more insurance and the good risk buy less. and there are studies that concluded just that. The relevance of the difference is this. Serious adverse selection can affect the functioning of the market. That can happen if regulation on rates is too strict, and in exceptional cases can also happen if there's large-scale misrepresentation. You will remember the example of the Israeli car insurance market. In cases like these, the government has to step in and correct that situation. We've seen that the Israeli government did just that. In the case of a certain company having incorrect rates, it's of course the company that has to take action and not the government. And if you compare the relevance of both, consider the frequency. Serious adverse selection is rare. During my 30 years in insurance, I never experienced it. Incorrect rates, on the other hand, are the order of the day. That's been the experience of the companies I worked for. Most of the times, the consequences were minor, but in a few cases, we incurred serious losses as a result. And this concludes my return to the real world. Let's quickly recap what we have found. We started from a scenario in which there were no impediments to the insurer gathering information. The assumption was the insurer knows better. I added that this is not merely speculative, but that there are convincing arguments that the assumption is correct. Then we introduced restrictive regulation. That certainly can create a situation in which the policyholder knows better. There are many examples of that being the case. It's not exactly known what tips the balance. However, the effect seems to be less than expected. I mentioned the ban on gender-based pricing in the EU and the fact that there are no signs yet that it causes adverse selection. I also mentioned the effects of insurance fraud and of competing social programs. In exceptional cases, both may cause adverse selections, but examples are rare. Finally, I discussed the difference between insurers. We have seen that this may create problems for one company, but not for the market as a whole. We've also seen that the usual empirical test may wrongly classify the situation as adverse selection. And this takes me to my final sheet. As regards the insurance market, the conclusion is that there's not much adverse selection. As I told you, that fits in well with my own professional experience. Now back to the beginning of this talk. Adverse selection is, as we said, the insurance variety of the concept of information asymmetry. If adverse selection is an overrated phenomenon, does that also apply to information asymmetry? Well, my knowledge outside the area of insurance is limited. However, I understand that information asymmetry is an important concept that plays a role in many markets. We don't find many examples of it in insurance, but it doesn't mean that it's lost its relevance elsewhere. You'll remember that the empirical studies focused on insurance because of all those structured data that we got. I think it's precisely because of these data being well structured that there isn't much information asymmetry in insurance. So, sorry, dear researchers, you picked the wrong example. The next question is it important to reverse the basic assumption as I did? If your starting point is a policyholder knowing better, then you have to explain many exceptions. If your starting point is the opposite, as I did, the insurer knowing better, you still have a lot of exceptions. So what's the difference? Well, I hope that the framework that I offered you provides you with a clear picture of what is relevant information and also what are the possible impediments in the flow of information between the policyholder and the insurer. But most of all, I hope I've convinced you that we should watch out for the one-line summary of the theory of adverse selection. As an example of that, a few years ago, I attended a presentation by someone who was doing a PhD on some aspect of social insurance. He gave an overview of his conclusions, and he started with a sheet stating, why do we have social insurance? Which, of course, is a very relevant question. And his answer was, quote, private insurance is exposed to information asymmetry and thus to market failure. That's why we need social insurance, unquote. And that's an example of the one-line summary I refer to. It misses the point. There are very valid reasons for introducing social programs, but the fear that private insurance is exposed to adverse selection is not one of those valid arguments. Or to put it more bluntly, it's nonsense. Thank you.
All right, that was great. So I'll take a queue of questions. I've been told that someone's having a tough time chatting with me directly in the WebEx. So if you'd like to just turn your camera on and raise your hand, I can put you on the queue, or you can use the little hand raise function in WebEx. Let's start with Peter Siegelman.
Great. Thank you very much. That was fantastic in every possible way, including the incredibly dry Dutch humor. I think it's Dutch humor anyway. So do I take you to be saying that you would be in favor of rules that require insurers to share information with each other so as to avoid the Israeli problem? I can think of two reasons why you might not want that. The first is the dynamic that you spoke of. If every time I make an innovation in my pricing, I have to communicate that to everybody else, then I lose my competitive advantage. So it means that I can't really get, I don't have a reason to undertake that. The other is the collusion, the monopoly problem, that we may just get, a lack of competition among insurers because everybody's now agreed to fix rates in a monopolistic way that, at least if it's the steel industry, we would think is a bad thing. Maybe in insurance, it's kind of an upside down world in some ways, so maybe it's not bad in insurance. But I just wondered if you had a reaction to either of those 2 points.
Yeah, okay, thank you. Now, of course, the idea is not, and I don't know the details of this situation in Israel, but I know the situation in my own country and a number of European countries. And the idea is not that you share everything. You don't share all your claims data. You share just one thing. If I switch from one company to the other, I take with me, so to say, my claims history. And I'm on grade, whatever, 11 of the bonus-malus scale, as it's called, which stands for I didn't have more than one accident in the last 10 years. I take that with me, and the other insured will know that that's correct. So the only thing I've taken out, or has been taken out in this example, is that I can't cheat anymore, I being the policyholder. Is that sufficient answer to your question? Okay.
Sure. I'd be interested to hear your thoughts about the collusion point as well, though. Are you worried? Would you be worried about that if the more information we have to share, the more we get to collude?
Yeah, no, I mean, obviously, we should watch out for monopolies, and so you should be very careful about these things, and you certainly shouldn't share data on rates and all that. But it's just that this particular point, which is a very relevant risk factor, a claims history, if you as an insurer, as the new insurer, cannot rely on that information being correct, then you're in big trouble. And then, and I think that was the situation in Israel before they changed legislation, resulted in monopolistic behavior, because the big insurers in those cases, well, they've got the data and they know whom to throw out and whom to keep. So I think that's the limited information exchange between companies.
Ken Klein.
Thank you. and thank you for that presentation. I actually have two questions, but not seeing any other hands up, I'll go ahead and soldier through both of them. The first is that there are markets, I'm thinking of particular underinsurance in homeowners insurance, where there's a great deal of law and regulation that solves the underinsurance by simply saying, well, nobody knows better than the homeowner what it would cost to reconstruct their home. And so my question is, since your research leads you to the conclusion that that premise is wrong, do you see any way to solve for that misconception other than to convince a court or a regulator that they are wrong and to change their premise? My second question is simply that the companies that do catastrophe modeling contend that not only can they model catastrophe risk, but they can model it down to an individual structure on a multi-structure address. And so given that premise, what is the explanation for why catastrophe loss needs to be dealt with external to the rest of your presentation?
Could I start with the last one? Well, I think experts differ. I happen to have a brother-in-law who is an American, and I told him about this presentation, and he reminded me of the fact that he had written an article about catastrophe modeling and all that, and he arrived at the conclusion that really insurers didn't know what they were talking about. Fine, I don't know, but it's a difficult matter. The point was that I think it makes sense when you make statements like I do about the insurer knowing better or the policyholder knowing better, that this is particularly an area where both of them don't know very well. And perhaps the insurer still knows a bit better, perhaps they don't. But it really is, as I understand, a big problem. The things like the Katrinas, if they double in size every time, you might know what you have to reserve for the next one, but who knows? They might triple in size. I don't know. And there's one thing about hurricanes that they don't always follow the course of the model. I'm sure you will agree with that. Now, your first question, does the policyholder know better about the reconstruction price of his home? He probably does. Yes, yeah, that's yeah. But is that relevant? Is it relevant that the policyholder knows better the reconstruction cost of his premises?
I take it you are actually asking me that as opposed
Yeah,
to
sorry, yeah, sorry, I should
rhetorically
have
asking
expressed
me
it.
that.
Yeah,
So my apologies. I actually think it is almost certain that a homeowner has no earthly idea what the reconstruction cost of
okay,
their home
yes,
is. All
yeah,
they know
yeah,
is what they paid for it or not. It's
yeah,
just
yeah,
that when a homeowner turns out to have insufficient funds to reconstruct after a loss,
yes,
the in the legal handling of that claim, of that contention to a disturbing frequency is the response, well, it's your home. You pick the insurance. No one knows better than you what the risk was of loss and what it would cost to do that loss. So it's a
yes,
contract, your problem.
yeah, that's true. Yeah. Well, that may be the case, but there are solutions to that, obviously. I mean, some insurers that I know built in options that even if your estimate as a policyholder of reconstruction cost is too low, they provide you with some additional cover and all that. So I don't think it is actually a problem of adverse selection here. It is indeed a well-meaning insurer will, through the policy conditions, assist the policyholder in limiting the damage that he or she might incur as a result of his own incorrect estimate. Okay.
I'll jump in. I just had a relatively narrow question. Do I take you to be saying that that you think that a subset of the empirical studies that claimed to demonstrate a presence of adverse selection
Yeah.
were really just using data sets that were derived from a single insurer that happened to just be not sufficiently competitive?
Yeah.
Is that a thing you're claiming here, or no?
Yes, yeah, that a subset. I found, now let's say 1.5 that I would label as such. Yes. Yeah. You may recall there is this famous example of, I think it was at Harvard University, that there were two competing health insurers. And the one was driven out by the other, so to say, and that was given as a prime example of the death spiral. I even believe that the author coined that phrase. But if you look carefully at it, there was nothing, it was not really adverse selection. It was just that the rates in one case were much more refined than in the other. So it was obvious, it could have been illustrated by the graph which I showed you. That is what happened. The one was driven out by the other, but not, there was no market-wide adverse selection. So in that sense, the answer is yes.
Got it. Josh Teitelbaum.
Thanks. I really enjoyed this. So a couple of questions, just, on your tallying of, and Peter obviously knows a lot better than I do, I love his survey article, but tallying the studies, I mean, it always comes to my mind that, this is a very hard phenomenon to identify econometrically. And so studies that don't find the effect, right, scientific method wise, that's not proof against it exactly, right? And the whole debate sort of reminds me of or is reminiscent of the, minimum wage like debate, that the theory is very compelling, right? That minimum wages should cause unemployment, particularly among low skill workers. But the evidence has been pretty hard to come by, and in fact, to the extent there is evidence, it kind of suggests, it's just not finding it, right? And there's a similar story here, that the theory is quite compelling, subject to, of course, right, the rationality assumption, which is very strong and could be the culprit for why it really doesn't exist. And the studies that aren't finding it really are not finding it for a good reason. But I'm a little uncomfortable just counting up studies and saying 50-50, and therefore, right, it's a very hard thing to identify. And it's a very compelling theory, subject to, very, very true and good behavioral critiques of the models that produce the compelling theory. That was one point. And
So
another point,
answer that first.
please go ahead.
Yeah. Look, I'm not just counting numbers. It's, I gave you an example. It's about 50-50, and I said earlier that this may not be a representative sample. It is just that if you got about half of the studies and assume for a moment that it is more or less representative, then you've got something to explain. And the focus of what I've tried to tell you is not so much on it. It's not correct. I'm trying to find the circumstances under which one could find adverse selection. And if I look at the explanation for the exceptions from a starting point that the policyholder knows better, then I sometimes arrive at things that I think, well, that's a bit complicated. And I believe that when you do it the other way around, as I tried to explain to you, then, as I said, obviously there is adverse selection occasionally. And I think that using the model or the framework which I propose to you, you've got a much more logical tale to tell. And the number of exceptions still remains roughly the same. There is adverse selection, but I think if you start from the point to, if the insurer in theory would get all the information he or she could get, yes, there wouldn't be any adverse selection, but I can see the circumstances under which the insurance company doesn't get that information. So, and I've mentioned a number of examples. Obviously, that's a very, very brief, very short list of examples. There could be more, yeah, of course. I just looked at, but these were the examples which I found in the 30 studies, and again, not measuring 16 in favor and 14 against, but saying what are the reasons behind the. So that's I hope that answers your first question.
It does, and look, I mean, I find it convincing that I would expect more evidence of adverse selection in these sort of regulatory scenario, you know, the artificial asymmetric information. You know, you would think that would be a fertile place to look for this, and not just, there are plenty of circumstances where it's totally plausible and sort of obvious that the information advantage is on the insurer side and not on the insured side, right? But the other thing I wanted to ask about was a more nuanced point, which was, you know, insureds can learn about their own risks from prices.
Yes.
Right. And so there's a feedback effect here. And maybe this is part of the story of, you're saying, when you have one sophisticated insurer and one less sophisticated insurer. And so a consumer can actually learn about their risk type from the prices the sophisticated insurer is offering them, and then go buy, if they're high risk, from the unsophisticated insurer. And that could be part of the dynamic, you know, that you're talking about, that's not market-wide adverse selection, but this is part of the dynamic as to what drives out the unsophisticated.
Yeah.
So there is an adverse selection story there. It's just, as you said, not market-wide. I'm just curious if I'm reading you right.
Yeah. Yeah, that's undoubtedly correct. I mean, I think we're talking semantics here. As I said, the situation that there's competition between companies on the basis of more refined and less refined rates, that is really, that's happening all the time. I think one would probably have to bear in mind also that insurers realize full well that they cannot have correct and competitive rates across the board. So what I've seen happening is that you're always focused on a certain area. It could be a geographical area, but it could also be that you're aiming for the middle-aged policyholders or whatever. Anyway, and you don't cover the whole area. And if you realize that, you may do all your sums, you've got all your algorithms and beautiful statistical analysis, but the fact of the matter is that you don't have enough information about insuring, say, young people driving in sports cars. So what do? Your statisticians have made a calculation and say that for this particular risk you should charge $2,000. But you know it's not reliable. So in fact, what you're doing is you say, well, okay, I don't like this risk because I don't know enough about it. I'll charge $3,000. So I'm pretty sure that I won't get any of that. That's the way it's working, I think. And in that particular way, you try to avoid the situation of, as we call it, that you're offering a window, of that you are a window. You're underpriced for a certain risk. Nevertheless, if you got millions of rating cells, you may have very sophisticated systems, but it's still possible that it occurs to you that all of a sudden you see that you get in pretty large numbers of risk which you wouldn't like to have. But I hope that more or less answers your question.
So Mr. de Jong has graciously agreed to stick around for a little bit after the hour. We've already gone over. Do you have time for one more question?
Yes, sir, please. Yeah.
Okay, so we'll give the last question to Walter Welsh.
Thank you. I'll speak for life insurance because that's the course I work on, and adverse selection. In fact, my students take a look at Professor Siegelman's paper and see whether they can understand it. The thing on life insurance, we mentioned earlier that you had the restriction on use of genetic information, which was
Yes.
put in. Many life insurers said they really weren't using genetic information, but what they really need are looking to get is health information and, more importantly, family history. It's amazing how your physician will ask you more about your family history every time you go for a physical than maybe they did in the past. And that information is in the hands of the insured, but not easily in the hands of the insurance company. So the life insurers think they have a different argument here on adverse selection than maybe other forms of insurance.
Yeah, that's correct. Undoubtedly, the problem always with these matters is that you've got your application form, you ask questions, and then people don't give truthful answers. That's the misrepresentation example which I gave.
Yes.
As long as that is minor, it's not a problem, and occasionally it becomes very much a problem. Yes, I know that. It is. So you're right. There might be a problem in life insurance too. Yeah.
Yeah. Thank you. Thank you.
Well, so I'd just like to, on behalf of everyone here, I'm sure, thank you, Casper, for a brilliant talk, brilliant presentation, and also for staying up with us to what I'm sure is a rather late hour your time. It was a real pleasure to have you. Thanks for coming.
Thank you. It was a pleasure.
Great. Wonderful. Thanks, everybody.
Thank you.
Bye-bye. See you.
Bye.